Good afternoon. I'm Michelle Nofel, Head of Distribution. Welcome to our City Different Investments First Quarter Roundtable. We have a full house today with our investment team. Joining us are fixed income co-portfolio managers Chris Ryan and Shweta Singh. Our newest member of our investment team, portfolio manager Rolf Kelly. Representing our global equity team is senior analyst Jong Lim. From our domestic equity team, we have portfolio managers Rob McDonald and Connor Brown. And we'll also hear from Joel Van Essen, Director of Private Investments. As a reminder, if you have questions, please type them in the comments box and we'll address them as time permits during the Q&A session. Let's get started with our fixed income team to provide a recap and their views on the fixed income markets.
Good afternoon, everyone, and thank you for joining us. Let me frame what Q1 2026 actually delivered, because it was not a single shock. It was a compound scenario, reaccelerating inflation, a constitutionally constrained fiscal lever when it comes to tariffs, a multi-year energy supply disruption, and a private credit market whose structural fragility became visible when investors needed liquidity. Let's start with inflation first. The year opened with a divergence that set tone of everything that followed. Q1 gave us two contradictory inflation signals simultaneously. Core CPI printed at 2.5% in January, the softest really since 2021. At the same time, core PCE, the Fed's favorite inflation measure, came in at January at 3.05%. Now, this is a 55 basis point gap seen in fewer than 4% of the time since 1959. Now, that spread was not just statistical noise. PCE actually carries heavier weight on financial services, food away from home, and memory chips, all of which were independently firming. By March of 2026, core PCE had risen to 3.2%. That is the highest since November of 2022 and more than 1 full percentage point above the Fed's 2% mandate. Moving on to tariffs and Operation Epic Fury. February set the stage for a worried equity market with AI bubble concerns and private credit emerging as the canary in the coal mine. And then within 8 days, two seismic events arrived. February 20th, the Supreme Court ruled 6-3 that IPA did not authorize presidential tariff authority, stripping the legal basis from approximately $175 billion in collective duties. Within hours, the administration pivoted to Section 122 of the Trade Act of 1974, imposing 10% global tariffs effective February 24th, now subject to a 150-day expiration clock and renewed constitutional challenge for this summer. February 28, Operation Epic Fury was launched. Iran closed Strait of Hormuz. WTI crude that was settling somewhere around $67 figure has dramatically shifted from there. This Fed, a Fed that was badly burned by transitory inflation stance, recognized Operation Epic Fury for exactly what it is, a supply-side inflation shock, structurally similar to COVID. On the heels of a hopeful peace talk, we are now looking at anywhere between 9 months to several years before LNG infrastructure, global supply chain begin to normalize. The combined effect is this: a tariff revenue that is maintained but has legal constraints, layered on top of energy price shock with multi-year structural tail, all arriving on a PCE baseline that is already above the Fed's target. So the Fed has very little room to respond in either direction. Moving on to private credit and liquidity stress. March 7th brought the next fault line into view. BlackRock and Blackstone activated redemption gates on private credit vehicles, stress testing a $2 trillion market and exposing liquidity mismatch that has been building quietly. Commercial paper spreads widened from 20 basis points to 38 basis points over the month, and the structural fragility that had been flagged for years became empirically visible. Moving on to employment. The trend that has emerged in Q1 is that the labor market is not soft enough to give the Fed cover to cut. However, it is also not strong enough to validate the inflation picture either. So this low hiring, low firing stasis combined with rising long-term unemployment and a structurally shifting break-even rate means that the FOMC simply cannot use the labor market deterioration as a trigger for rate cut, even as energy shock continues to feed through the prices. Finally, let's talk about the FOMC itself. We are coming off last week's Fed meeting. The story was not the hold itself. It was the 4 dissents that we saw, the most since 1992. 3 regional bank Feds objected to the easing bias embedded in the statement language. 1 governor favored cutting. This asymmetry matters. There are 3 hawks, 1 dove, and 0 certainty of a rate cut for the second half of the year. Another point I want to mention is Powell remaining on the board. Now, as he remains on the board of governor, it carries more structural weight than we think the market is giving. The administration's ability to reshape the board slows down materially from here. The next opening does not arrive till January of 2028, absent any voluntary departures, of course. Now, Kevin Warsh takes the seat of the chair, but he inherits a board that will move on its own timeline. Warsh represents a deliberate break from the Powell framework. And with that, I will pass the baton to Chris Ryan to take us through what that means for rates and positioning.
Well, as Shweta mentioned, we now have a new chairman of the board of the Fed, Kevin Warsh. He got through Senate confirmation hearings because Senator Tillis was given assurances that the DOJ was going to drop their pursuit of Jerome Powell in terms of investigations. Take that for what you will. So anyway, Warsh is now going to be the new chair. What does that mean going forward? Well, it looks like there's going to be 3 or 4 members of the 12-member voting board that are going to be wanting to lower short-term rates. Kevin Warsh has come up with a great idea to fix the inflation problem the Fed is facing. Change the measure. He's moving from looking at core PCE to what the Fed normally looks at to looking at a measure that the Dallas Fed uses called a trim mean. What does that mean? Well, core PCE has been running about 3.1% or 3%, okay? If you were to go to the Dallas trim mean, the inflation would look to be 2.3 to 2.4%, a 60 to 70 basis point lowering of the inflation target, getting it much closer in line with the Fed's projections or the Fed's target of 2%. Well, that would give the Fed a lot more room to lower short-term rates, which, as we know, is one of the president's big bugaboos. Take that in combination with Warsh wanting to manage the balance sheet, shrink the balance sheet. We think that could cause higher long-term rates, definitely more volatility because he'd like more vibrant debate at the board when they discuss what to do with short-term rates. So what this could mean is a steepening yield curve. Short rates going down, long rates increasing, and more volatility in the fixed income markets. So what should fixed income investors be concerned about? We were talking about that this morning. Connor got all excited when I said the volatility measure we should be looking at is the second derivative of yield. It's known as convexity. And what that means is that as rates change, the duration of the underlying security could change because of the embedded options in that in the security. The things that are going to drive it are dollar price, how much are the embedded options in the money or out of the money, but not to get stuck on the minutia. It is something that investors should begin to be concerned about in in going into a more volatile environment. And your investment advisor should be able to uh, highlight what the convexity of your accounts are. With that, I'll turn it back to Michelle.
Thank you, Chris. Right now we'll go to Rolf. Rolf will share some thoughts on AI disruption and finding opportunities in areas of pain, dislocation, or neglect. Rolf?
Yeah. First, Chris, I love the fact the government just keep changing the goalpost, right? And let's just pull out anything that has inflation in it, like healthcare or food, and just measure all the things that deflate. But that's another discussion for another time. So AI was shocking to us and to me this past 3-4 months. And what was so shocking was the developments of what companies were saying. And I'm going to paraphrase, but some of our companies we've been tracking for a long time came out and said their best coders and software developers were no longer writing any code whatsoever, which was kind of a mind bender for us and made us sit down and assess every company in the portfolio and how this might affect. And we have actually, it caused us to exit or get out of some of our favorite investments. And for me personally, the payment space has been a long-term 15-year holding of Visa, MasterCard, Adyen, some of these companies because of the uncertainties arising from these developments, along with some of the digital currency developments that have been happening at the same time. So it's an important step, though, for a manager to, when the evidence is there, to exit some of your most loved ideas, and when the uncertainty is as high as it is, we felt it was time to move on. At the same time, because of AI sucking all the oxygen out of the room and all the fund flows and the momentum markets that we're in, there's some interesting places opening up for opportunities, in our opinion. And healthcare has been one of the best sectors of all time to be invested in. And in the last, so far this year, it's been one of the worst performing sectors globally. And man, there's some great businesses there. There is some short-term pain. We've got COVID hangover that we're getting over, NIH funding cuts, which have hit the industry. But then you have some of the best moats in the world in this industry around these companies. And we've gone sniffing, and it's particularly around biological drugs. Drug development historically has been small molecule or chemical compounds, and we are shifting rapidly towards biological compounds, which have to be grown. So there's a whole bunch more complexity of growing and creating the right cultures to grow these molecules and to filter and get out all the byproducts and whatnot. So the complexity is increasing as we're pursuing monoclonal antibody therapies, cell gene therapies, immunotherapies, mRNAs. All these buzzwords mean biological compounds when you hear them. And there's some companies positioned beautifully in this industry with incredible moats developing because of the complexity, and they're getting FDA sort of approved into the process. So in order to rip out those components that these companies are selling, you'll have to get reapproval from the FDA. So we love this, love the moats, and you can follow up and hear about those companies specifically. I'll leave it a cliffhanger on what companies we actually purchased.
Thanks, Rolf. Jong, the conflict in Iran has disrupted oil markets, but how has that benefited some of the stocks in our global portfolios?
Yeah. So like Shraddha mentioned, a lot happened during the quarter, and the biggest event we think is the Iran war. And as many of you know, energy transition, that has been one of the kind of big themes in our portfolio since inception. So naturally for the global team, we are monitoring the war's impact on the energy markets super closely. And we believe the Iran war actually accelerated and even magnified some of these kind of energy related investments that we've been making. I mean, we didn't predict the Iran war, but it has benefited us, so we'll take it. The war really highlighted the vulnerability, kind of relying so much on the Middle Eastern oil. And what would happen to energy prices when just a bunch of ships cannot get past the Strait of Hormuz. We've heard about it, but then it's kind of it's happening in the day to day, and we see it in the gas prices that kind of hurt a lot of consumers when we go to the gas to gas stations. So at higher oil prices and also for security concerns, we think the world, I mean, just have no choice but to diversify more into offshore oil and gas drilling. And frankly, during the quarter, market reacted accordingly. So that has benefited our investments in, say, Tidewater and Seadrill. And we think the market could still be underestimating how the long-term trend could be towards offshore drilling. So we are again studying and monitoring the situation, and maybe we would uncover more opportunities in the area in the future.
Let's shift over to the US markets. Rob, what's going on in the US and where are you finding opportunities?
Yeah, thanks. There's a lot going on in the US. Very exciting. The markets have been doing well lately. And the big driver of stock performance has really been momentum. With the adoption of AI, these hyperscalers are spending such an unprecedented amount on data centers. And so, stocks that have done really well are starting to look really expensive on early multiple, but the magnitude of spend is so big, and the potential for earnings power are so big that like high multiples, doesn't necessarily mean overvalued. So my investment style tilts a little bit on the value side. So I kind of think a lot about reversion to the mean and have a high focus on valuation, which is kind of the opposite of momentum. So in our domestic portfolio, like we've been struggling to keep balance. And so in our sort of like, you can think of our AI exposure, our largest holding is a company called Flex, which is a contract manufacturer. And so within part of their exposure, part of their business is handling power and cooling for data centers. And so as chips get more powerful, they need more power and they need more cooling. And so the service and the products they provide are becoming increasingly important for their hyperscaler customers. And so the earnings power at Flex, continues to surprise to the upside. So today, momentum's really important in the market. Tomorrow, it'll be some other factor. And we're going to do our best to try to stay balanced.
Thank you, Rob. All right, we'll go over to Joel Van Essen. We'll share his thoughts on the state of the small business ecosystem.
Yeah, thanks, Michelle. Yeah, I wanted to just touch on an interesting report that McKinsey published in February of this year that had a lot of good data points on kind of the underlying thesis of our small business acquisition strategy, as well as a lot of the other small business buyers out there. Just put some validity on, where we're seeing opportunity. So they surveyed a variety of different business owners, and 92% of small business exits occur through closure at this point, only 5% through sale and 3% through family transfer. They estimate that 6 to 13% of those businesses that are closing are still viable, businesses moving forward. It's more of a matter of not being able to find an interested buyer. And there's plenty of buyers out there. It's really just a fragmentation problem where it's difficult for buyers and sellers to match up to actually close on a transaction. And so there's a lot of opportunity from a market perspective there. They go on to say that over the next decade, they think that a well-functioning transition market could keep up to 12 million jobs in place and protect roughly 250 billion in annual local spending power. So at the core of it, this is not just a market opportunity, but we're also talking about a pretty major macro event with real consequences for communities, workforces, and supply chains. All this goes to say that, we're continue to be excited about the opportunity in buying small businesses. And back over to you, Michelle.
Thanks, Joel. All right, let's open it up to questions. If you have any questions, feel free to type them in the chat box and we've got a few minutes for some questions. Okay, first question around AI. Connor, do you want to take this? I know Claude has become one of your new best friends here. What's your take on the big picture impact and what AI means to the market?
Yeah, I am a little deep down the rabbit hole, as my colleagues here at City Different know. If you haven't downloaded and started to use either Claude Cowork or OpenAI's Codex agentic agents, I highly recommend you do. It takes the work that you do with AI tools to a whole nother level. We're at this awesome position as a fast-growing business, pretty lean team that we can really lean into these tools to make everyone on our team more productive. What does this mean for the big picture? There were two good articles in the journal this morning about the different ways that companies are looking at and putting AI to work within their workforces. We have seen layoffs, especially in the tech industry, and there's a little bit of some stocks are getting a pop on their announced layoffs when they say that it's about their AI usage driving layoffs. So that's a trend that's frankly a bit worrisome. You guys may remember before the conflict in Iran, there was a research paper out about the coming white-collar job crisis and the follow-on effects that might occur. And that's something that we pay a lot of attention to, that we're monitoring. On the other side, in the journal too, there were good reports on businesses that are making the choice to keep employees, believe that AI plus humans do more and better work, and get really excited about all of the additional work that a company can get done, how they can move faster and provide more products and services. So I've got lots of friends who are using lots of AI, many colleagues here, but colleagues across New Mexico. In all of our experience, using the AI tools has created more work, not less. There's this dream of a 20-hour work week where you're getting just as much done. That's not how it happens. In fact, you start to use the tools, you get more done, you get excited, you sleep less, figure out that next thing that you can get it working on. I honestly believe that over time, work will grow. And probably what that means in a good case is that global consumption grows to keep up with workforce productivity. Is that good or bad? We can argue about that as long as you want. But we're really excited. Last thing just to mention is that we've been worried at times about an AI bubble. There's been tremendous investment. At the moment, in the last couple of months, so far, demand seems to be outstripping supply. So the AI leading labs can't keep up with demand. They need compute, they need power. We're seeing that across all of the providers, every step down the value chain. It's not just NVIDIA chips, it's any other chip that can be used across Intel, AMD, Google's chips, everywhere. So in the last couple of months, in this agentic, quote unquote, agentic revolution, it does feel like the demand is there to continue to keep driving further demand and growth. We worry about economy built entirely almost on incremental demand for AI capacity. That's a real risk. But in the last couple of months, the demand has been there. So get to work, use the tools, have fun.
Thank you all for joining us today. If you have any questions, feel free to reach out, and we'll see you next quarter. Thanks so much.